Hey everyone, Scott here from Luminary Wealth. With the anticipation of a big presidential election just a few days away, many of us may be feeling a little anxious. We want to know if we should be changing our portfolios. How will a Trump win impact the markets? What will a Biden win mean for the next 4 years? If only we could see tomorrow's headlines today. While we know that's impossible, we do have lessons from history that may guide us today and keep us grounded even after the election. Now more than ever, we need to separate emotion from reason. Reason that is based on evidence. Make sure you watch Andy's video he just posted talking about the historic impact of presidents and party affiliation on stock market returns. He reminds us that we tend to oversimplify factors that impact financial markets. We vest a lot of influence in the office of the presidency and party in control of Congress. While governmental policy does matter, there are hundreds of factors outside of the government's control that impacts markets. Just look at what we've experienced this year. Who could have predicted the pandemic coming? One that shut down a large part of the global economy. Or who would have predicted what we just experienced this quarter with a 33% growth in GDP in the midst of a pandemic? Andy gives you a solid overview. I'm going to dig a little deeper into the numbers to give you a picture of the impact elections have on financial market returns. Let's take a look at a few slides showing the evidence of how the S&P 500 has rewarded disciplined investors for decades through both Democrat and Republican presidencies. So the first slide we're going to look at is the annualized returns of the S&P 500 during presidential terms from Nixon in 1969 through Trump's third quarter of 2020. And the question I have is, by looking at these returns, can you see any pattern, any discernible pattern that would provide you any predictive value in predicting which president's going to give you what return in the future? Well, I think the clear answer is no. We had 9 terms here, and I think you really can't make any judgment by what we see here. There's no discernible advantage one president or party had over any other. So the slide we're looking at here gives us a longer-term view showing steady growth in the S&P 500 over all presidential terms, beginning with Hoover in 1930, running through the third quarter of 2020 with President Trump. I wanted to look at also what the actual return was of the S&P during each presidential term, and I recorded that at the bottom right above their portraits in white. I wanted to then match that with the significant world events that occurred during each president's term in office, and I wrote those in black across the top. And so while it makes sense that the president's policies exert some influence on the financial markets, obviously taxes, regulations, fiscal policy, foreign policy, you can see there are many events that occur across the world that are completely outside of the president's control that impacts the market's performance. And these events are largely unforeseen and incapable of prediction. Who would have predicted Pearl Harbor or, most recently, the Great Financial Crisis before they occurred? As I previously mentioned, the pandemic we're living in now is a key example. It turned a booming economy and record stock market on its head, driving unemployment to 15% and a drop in the S&P by more than 30% in a mere 4 weeks. Think about that. 4 weeks. And the market recovery was no less amazing and unexpected, as the U.S. market sits near its pre-pandemic levels. And we just got word of the third quarter growing 33% GDP, which is an off-the-charts record. So I think the lesson we learn is that markets are unpredictable in the short run, but it rewards long-term discipline to those who stay invested at the appropriate risk level for you. No matter how plausible our story is to explain what we think is a certainty, the world we live in is filled with uncertainty, and events have occurred during every presidential term that affected the market in unforeseen ways. So attempting to read the proverbial tea leaves is a mistake. The market rewards those who stay the course. Okay, this is a fun slide. Really doesn't mean much based on what we saw in the last slide. Thought it was a fun exercise to do anyway. So I took the same period of time, those 91.3 quarter years from Hoover through Trump, and the annualized return for that period was about just under 10%. with the average return being about a little over 10. And what I did was I looked at how long each party held the office of the presidency. Democrats held it for 48 years, while the Republicans held it for 43 and 3/4 years. And then I weighted the S&P return during each of those terms. What I mean by weighted is that, for example, FDR was in office for 12 years, so I weighted that at 11.6 by the 12 years, while Gerald Ford was only in for a little more than 2. So I had to weight his for only 2 of the 91 and 3/4. And so when you do that, what you end up with is the Democrats returning an average weighted return, or an annualized weighted return of about 7.17, while the Republicans returned to 2.98 annualized weighted return. Again, this is meaningless, but I thought it was fun to do anyway. Hope you enjoyed it. Hope you found it interesting. And I really hope that this video can help you stay calm and maybe reduce some anxiety and fear that this election season may bring you. As always, as we have reminded you, stay in your seat. And look, by all means, strap your seatbelt, because the ride might be a little bit bumpy. But stay in your seat. That has been and will continue to be the best strategy for maximizing your long-term wealth. As always, if you have any questions, please reach out to us. We'd love to chat, talk, and until we talk again, stay healthy.